So now, Martin with basics about futures.
Okay, hello everybody from me as well. Thanks for joining us tonight and thanks for the introduction, Dirk. Okay, today's session will focus on futures. What are futures? How to trade them? What makes them different from stocks or ETFs? What are the pitfalls of trading futures and things like that. So let's maybe start with the definition of futures. What is a future? A future contract is an agreement between two parties. One of the parties is the buyer and the other one is the seller. To sell a fixed quantity and grade of a commodity, security, currency, index or whatever, to an agreed upon price in the future, at a given date in the future. Okay, so much for the definition. Maybe it's easier to understand futures by understanding their properties. So futures are generally exchange-traded derivatives. They are created by an agreement between a buyer and a seller. So a future contract can be created by market participants. The buyer is said to be long the future. He receives the delivery at the contract maturity, and the seller is said to be short. He makes the delivery. Yeah, futures contracts can be extinguished by an offsetting transaction at any time, prior to the maturity, of course. So just the same way as they are created by an agreement of two people, they can be extinguished by an agreement of two people. They can be settled upon their maturity by either cash or physical delivery. And the best property of futures is that they are standardized. We will talk about this standardization. Standardized in terms of quality of the underlying, of course. So what is the future about? There are futures about with underlying crude oil, with corn, with wheat, with all kinds of different underlying. So the underlying is well defined in each future contract. Then, of course, the contract size. This is also something that is standardized across futures. So if you buy a crude oil future, that always means that your contract is about buying or selling 1,000 barrels of crude oil. Never more, never less. So the quantity, contract size is also standardized. Then we have standardized settlement mechanics, such as a delivery location, if it's physically delivered, or cash settlement. So this would just be the difference between the future price and the spot market, the locked-in price. Yeah, then of course delivery or maturity dates. Not every future has a delivery date in every month. Crude oil is an example that has a delivery or a contract for every month, but some agricultural commodities, for example, do not have all contract months. Yeah, and then perhaps most importantly, the specific grade or quality of the contract. So even if you trade crude oil, there are several grades of crude oil. So Brent crude oil is different from West Texas Intermediate crude oil. There are grades that are well defined in the future contract. Okay, which markets can become futures markets? There are certain requisites of a market that it has to fulfill before it can, before a future market on the underlying makes sense. First and foremost, producers and users need to manage a real economic risk. So in terms of crude oil, producers of crude oil, people who own, I don't know, an oil drilling plant, whatever, and people who own a refinery have to manage real business risk. They have to manage the price of crude oil at future dates. And yeah, that's one of the requisites of futures markets. So they need a vehicle, a future, in order to manage the risk of price changes of the underlying markets. So it must be based on an active underlying or cash market, a real good, so to say. And there has to be an efficient delivery structure for that future. And of course, the last important point is government policy. It makes absolutely no sense to have futures if the governments regulate the prices. So if there is no free market for the underlying commodity, it makes no sense to have a future. Okay, where did it come from? The origin of futures. They are actually pretty old already. It started around 1864 in Chicago Board of Trade. The difference, between futures and forwards, because the concept of forwards is maybe a little older. Let me briefly address that. A future is a standardized forward. So a forward can be any agreement to a delivery of an underlying commodity at a future date, while a future has a specific rate, a specific contract size, specific quality, specific settlement dates, and so on. So I could theoretically create a forward and sell Dirk my car in May next year. This would be a forward contract. Why not? But it's not standardized in any way, and it's not exchange traded. So the origin of these standardized and exchange traded futures was around 1864. And in the beginning, it was primarily used for agricultural commodities. So as you can see here in these pie charts, actually the futures markets were pretty long, almost exclusively about agricultural commodities. But this changed significantly in the last 40 years. And as you can see now here, today most futures are already about financial instruments, so stock indices and so on. And the percentage of agricultural commodities decreased significantly in the last 40 years because, futures are an efficient vehicle for trading. So wherever there is an underlying that needs to be managed, that can be standardized, the future makes sense. Why are futures attractive? They are among the most liquid markets in the world. Actually, to my knowledge, the only markets that are more liquid or as liquid as futures are the foreign exchange rates of the G10. But other than that, futures are the most liquid markets in the world. Liquidity is always good because that means that if I want to buy, I find a seller and the other way around. So liquidity is actually a very important feature of a market. Then they are regulated and standardized. These are also good things. I know what I get. If I buy a contract of 1,000 barrels of crude oil, I know exactly where to get them, when to get them, what I get. Regulation is also very good, because it leads to standardization. Then another very attractive property of futures is you have a very low counterparty default risk, since the clearinghouse, this is an entity of futures trading of the exchange, substitutes itself as counterparty. So this means that if I agree with Dirk on the delivery of crude oil in April 2015, so let's assume I have 1,000 barrels of crude oil by then, and Dirk wants 1,000 barrels of crude oil by then, we open up a future contract and lock in already today the price at which we intend to make that delivery in April next year. Then this means in practice, so in trading practice, not that Dirk and I agree on that future contract, but we agree on the contract with or through the clearinghouse. So the clearinghouse substitutes itself as the counterparty of the future that is opened between Dirk and me. So I don't know who my counterparty is if I trade a future contract, if I open a future contract. The clearinghouse is always the counterparty. And since it substitutes itself as counterparty, there is a very low default risk, because even if I don't know, go bankrupt by then, it's not, so the clearinghouse has to step in, so to say, and guarantee that Dirk's side of the contract is fulfilled. Okay, then another advantage, another practical advantage of futures is that today there are very diverse instruments that are already covered by futures. So you have futures on foreign exchange markets, you have futures on agricultural commodities, you have futures on metals, on energy, on interest rates, on stock indices, on very diverse instruments, which leads to uncorrelated markets. So if you have a trading strategy that works well on many uncorrelated markets, you have a higher chance that this trading strategy works in all market phases. If we use the word market phase, usually market is used as a synonym for the S&P 500. So very diverse uncorrelated markets that can generate positive returns in all market phases and all circumstances. And of course there is Also, the good property of futures that they can be used to reduce / hedge unwanted business risk. So if you run an airline, for example, you might want to know today how much you have to pay for kerosene, gasoline, crude oil, whatever, in the next year. You can do that by just buying a future contract that guarantees you the delivery of kerosene that you need to run your planes in the next year already today. So you can really hedge against unwanted business risks. Okay, then let's get to the mechanics of trading futures. Or are there any questions to that part so far? Any questions? Very liquid. Yeah, it depends. One of the most liquid, if not the most liquid, future contract is the S&P 500, the minis. Yeah, I don't know. Ticks happen in milliseconds, so that's really, yeah, it's not a problem to trade huge quantities or to manage huge quantities with futures. So, yeah, pretty liquid and pretty attractive markets. Then there are, of course, on the other end of the spectrum, if you have the lumber future, this is not very liquid, but still it has roughly a volume of 1,000 contracts per day. A contract is roughly worth 40K, so this makes roughly 40 million a day for a very illiquid future that are traded in terms of notional contract value. This is the lower end of the spectrum. Okay, so the mechanics of trading futures. Like I said already, a future contract can be opened by simply two people agreeing on creating a future. So if I want to deliver or buy, let's say, corn in March 2016, I can just simply open a future contract that guarantees me today already at which price I can sell my corn in March of the next year. So let's assume I want to sell corn, Dirk wants to buy corn, we create a future contract. Even though we don't know each other, this is done through the exchange. So when a contract is opened, both parties, both sides of the contract, they'll need to pay the full contract amount. So let's assume that the delivery of my 5,000 bushels of corn in March next year would cost Dirk $25,000. But in order to open the future contract, neither Dirk nor I need to put $25,000 on the table, but only a percentage of that. This is called the initial margin in order to open and to maintain the contract. So let's assume the initial margin is usually depending on your the agreements that you have with your broker, depending on the contract and what the exchange allows and so on. It's between 5 and 15% of the notional contract value. So if we agree on a delivery of the 5,000 bushels of corn for 25K, then let's assume the initial margin is 10%. Then both Dirk and I need to deposit at the broker, at the clearinghouse, at the exchange, $2,500 now in order to open up the future contract, to open up the position. This is called the initial margin. The full price of the contract is only paid upon physical delivery. So in March 2016, if Dirk really wants to have the corn that I produced in the meantime, he needs to pay me the full contract amount, but not before. So in March 2016, he would need the 25K. Yeah, a future position can be maintained with much less capital than its notional value, and this is called buying on margin. This is exactly the process that I just described, and this gives you, of course, leverage. So I can maintain a position that is exposed to the risk of 5,000 bushels of corn that would cost, if I would buy it on the spot market, 25K with just $2,500. So I have a trade with a leverage of 1 to 10. Yeah, and then again, I mentioned it, the future is offset if the opposite transaction is made. So it's not necessary, if Dirk and I open a future contract, it's not necessary that we wait until it expires. We can agree anytime prior to the contract maturity that we want to close the contract, simply by an offsetting transaction. So if I'm the short, I buy a long contract, or I sell my short, it's the same. And Dirk does the exact opposite. Okay, here we have another example for margin and leverage. Let's assume we want to go long one 10-year note. The notional contract value of a 10-year note, this is the government bond, is 130K. And let's assume that the initial margin of it is 10%, so 13K. This gives us the position, a leverage of 1 to 10. I can actually trade a future and be exposed to a risk of 130K with just depositing 30K. But now comes the downside or the upside, depending on how the price develops. If the 10-year note price falls by, let's assume 6.5K, which is a 5% move against us if we think of the notional contract value, we have suffered a 5% loss based on the notional contract value. But if we base that on the initial margin that we've deposited, this is already a 50% loss because we deposited 13K, we lost 6.5. So we have lost 50% of the initial margin. So in this case, what happens if that really happens in reality? You get a margin call from the broker because usually you have to maintain a certain amount of capital in your trading account. This is the so-called maintenance margin in order to maintain the long position. So the broker would ask you to deposit additional funds in your account. If the position moved, for example, 6.5K now against you, if you cannot deposit additional accounts in your broker account, additional funds in your account, the position is liquidated automatically by the broker. But this, and this is also very important, does not protect you if the position moved more than your initial margin against you. So if the price move was not 5% in terms of initial margin, but 20% in terms of initial margin against us, we still need to pay the broker for the 26K that we've just lost, even though we just deposited 13K in the account. So initial margin does not protect you from a loss or from the risk that you're exposed to. This is very important. So leverage works both ways. And of course, it can be extremely dangerous if it's not managed properly. Any questions to that? Margins? Everything clear? Oh, okay, cool. Yeah, then let's maybe get back to the properties of a future. Of course, this is just some of the properties, but to give you an idea. So the first thing that needs to be defined is the underlying. What is the future about? Let's assume it's corn. Then the unit of corn would be a bushel, and the contract size is always 5,000 bushels. So there is no way to trade half a future or a quarter future, trade a fraction of the 5,000 bushels. You can only trade multiples of 5,000 bushels by buying future contracts worth 5,000 bushels each. Then the price quotation, usually this is either dollars or cents per bushel, so per unit. So that's why the price quotation, if you look at Finance Yahoo, for example, the quotation for crude oil there, if you look at the crude oil quote, this is always the price of 1 barrel of crude oil. So if you look today on Finance Yahoo, this is probably around 41 something. So $41 per barrel of crude oil, but the contract size of the crude oil future contract is 1,000 barrels. So always. So a future contract is worth 40,000 instead of the 40 that is listed on Yahoo. Yeah, then of course the settlement procedure. Some future contracts are cash settled. That means that that there is actually no physical delivery possible. For example, some foreign exchange futures or some equity futures, so the S&P 500 might be cash settled. Also some agricultural futures are cash settled. But for most futures, there is indeed a physical delivery procedure in place. This could be, for example, at the CME, at a specified warehouse where you get your, corn or your lean hogs or whatever. The reason for that is, again, that there is a real business risk that people have to hedge themselves against. So a farmer really wants to deliver his corn, so that's why there has to be an efficient delivery structure for physical delivery. Yeah, then also important are the contract months. I mentioned already, not every future trades every month. This is an example for corn. So corn has 5 delivery months. Don't ask me why. This is somewhat related to the crop cycle. I'm no farmer, I have no idea. But some futures have deliveries or contracts every month, and most agricultural commodities don't have deliveries every month. Yeah, and then 2 very important dates for trading futures. This is the last trading day and the first notice day. If you don't want physical delivery, or if you don't want to risk physical delivery, if you're a trader, a speculator, you usually don't want the corn delivered or be forced to deliver the corn yourself. You want to be out of the market at the earlier of those 2 days. So the last trading day would be the last day where I can trade the future on the exchange. This is usually some days prior to the maturity of the contract. And the first notice day is the day where the holder of a short contract could announce that he wants to make the delivery. So usually the delivery of the underlying does not happen on one specified day, but let's say during a week or so. So if this is a March contract for corn again, then the physical delivery of this guy could happen in, let's say, the 3rd week of March. So the short could announce on Monday of the 3rd week of March that he wants to make delivery. And if you get that announcement, you have to accept it when you're still in the long contract at that point. So if you're a trader, if you're a speculator, you might want to be out of the market at the earlier of the 2 days, so at the earlier of the last trading day or the first notice day. Any questions to contract properties? Yes?
They need to be the same, the last trading day and first notice.
Okay, the question is if they are the same. Not necessarily. Not necessarily. There are contracts that's really different from contract to contract. You can look the property up on the CME page, for example, if you're trading futures that are listed on the CME. It could be that you could actually trade after first notice day. Could happen. And it's also possible that that it's the other way around, so that the last trading day is way before the first notice day. But that's also bad, because if you miss the last trading day, you're stuck in the future basically, because the exchange is no longer open. You cannot offset it anymore. So you really have to wait then the week until the first notice day, until the short makes his delivery, and you have to accept it. So you might want to be out of the market by then, yeah?
I don't know if this question is too early. For your backtesting, how do you construct a
Yeah, we'll get to that in a minute. So the question was for the backtesting, how we do that. We construct a continuous contract, and we do this on a rolling basis. This is called rolling, and this is exactly the next thing that I want to address. One of the main differences between futures and, let's say, the stock is that futures contracts expire at some point. So in April 2016, all March 2016 contracts are obsolete already, because the physical delivery has happened already. So March 2016 is already in the past by then. So there are no more March 2016 contracts. This leads to the conclusion that there is no static course for a future. So for a stock, if you buy a stock, you own a percentage of the company. There's a course for that every day. You know at what price you can buy it, at what price you can sell it. And if you don't want to own it any longer, you just sell it. So there's a steady course every day. This is not the case for futures. If you want to be to trade the risk, to be exposed to the market risk of a future beyond its point of expiration. So let's assume again I have a corn contract short for March 2016, but for whatever reason I want to be exposed to corn short until June 2016. Then I would need to sell my March 2016 contract, or buy a long, since I'm the short, and instead go short the June 2016 contract. This process is called rolling from the front contract to the first back contract. So this is an example of a roll. Another example, let's assume I do have a 10-year note 2015 December, but for whatever reason I want to be invested in the 10-year note until February 2016. So at some point, prior to the expiration of the contract, I have to sell my 10-year note 2015 December and buy another 10-year note for that. In this case, it would be the March 2016 10-year note. Okay. Yeah, the downside or upside, depending on what you trade, of this is the contracts with different maturities usually don't come with the same price. There is usually a cost of carry, for example, for storage of a physical commodity, or the opposite would then be backwardation. For commodities where we do have a cost of carry, we say that they are in contango. That means that the price of a contract further ahead in the future is usually more expensive than the spot price, or a future that expires closer or sooner. This is contango. This is, so to say, the normal behavior of a future. If you have crude oil and if you sell it in June, you have to store it until June. So this storage process costs you, it costs you money to put it in a warehouse. So if you sell it in June, you usually sell it to a premium over, for example, March. This is called contango. And the normal behavior, backwardation, is the opposite. So this is when the price of a future at a later maturity is actually lower than it is right now. This can also happen, for example, due to a shortage on the spot market. So let's assume I'm again a farmer, I produce corn, and Dirk, I don't know, runs a factory that makes breakfast cereals. My corn is not ready yet. We have a shortage on the spot market. If Dirk really needs the corn right now, he needs to pay a premium. I can deliver him the corn. I have not planted it even yet, but I can deliver it to him in June, no problem. But right now, yeah, it is a problem since I don't even have it yet. And if he really, really needs the corn, then he has to buy it on the spot market. There is a shortage currently, so the price of the spot market is higher than the price of the delivery that we would agree upon in June. So Dirk has to pay a premium, and this is called backwardation. Yeah, this is just an illustration of time versus premium that you have to pay. The blue curve on top would be the forward price in contango, and the light blue curve is the forward curve of the price in backwardation. Okay, this is taken from the CME a couple of weeks ago. I will try to increase it here. Okay, this is just an illustration of how contango and backwardation in real numbers work. This is the crude oil contract taken a couple of weeks ago from the CME. Crude oil, January 2016, had a price of $47. If you want the same crude oil in February, it already costs $48.21. If you want it in March, it costs $48.90, and so on. So this is the classical example of a future market being in contango. So the later the maturity, the higher the premium that you have to pay, simply because of storage costs. Okay. Are there any questions to contango or backwardation? Okay, cool. Yeah, then liquidity. We already talked a little about liquidity. Liquidity of a future can be measured by either one of the two variables, or ideally by both. This is volume and open interest. Volume is just the same that you know from stocks. So if I sell a contract that I own to somebody I create a volume of +1. The second thing that is future specific is the open interest. So let's again assume I open a contract because I want to deliver crude oil. I have a counterparty for that. Dirk wants the crude oil. This transaction increases the open interest of the future by 1. We agree on a contract, we open the contract is created, the open interest rises by 1. If now either Dirk or I sell our end of the contract to somebody else, then this creates a volume of 1, but the open interest stays the same because no new contract has been opened. So open interest is simply the number of longs or shorts, it's the same number, that are simultaneously not settled in that particular future market. So not offset by a transaction. So this is a future specific. Yeah, and then the contract that with the closest expiration date is usually called the front contract, and all the other contracts are called back contracts. Usually, in 90% at least of the cases, the front contract is the most liquid contract until it approaches either its first notice or last trading day, because at the earlier of those 2 days, all speculators are leaving the market. They roll in the future with a longer maturity. So you can see in the open interest that the open interest declines towards the expiration of the future contract. And after the later of first notice or last trading day, only the hedgers are still invested in the future and they would get physical delivery. Usually we want to be invested in the front contract because it is the most liquid one. Yeah, who participates in futures markets? We already mentioned the 2 parties. The first ones would be hedgers, so people who want to hedge themselves or companies who want to hedge themselves against price fluctuation, against the risk of price fluctuation, who wants to lock in the price of a good that might not even have been produced yet. So as a farmer, I can already sell the crop that I have not even planted yet to a guaranteed price on the CME exchange. So these would be hedgers. And the second participants are speculators. So traders, people who work with risk. They don't actually want the physical delivery. They just want to be exposed to the price risk of the market. Traders. Yeah, traders are per se nothing bad. Exactly there, to be correct. They are even very important for functioning futures markets simply because they are willing or they are providing the market with liquidity. So traders are usually willing to buy if the farmer wants to sell. This is not necessarily the same time where the breakfast cereal producer wants to buy. So it is important that speculators exist in the market because they simply provide liquidity. They provide hedges with the opportunity to manage the risk. Okay, this brings us already to the future data that we have. Like Dirk already said, initially the purpose of our platform, of Quantiacs, is to empower you to write trading strategies and, if you want, to market these trading strategies to institutional investors. To empower you, we provide you with futures data, backtesting data, and with the backtesting toolbox that is written in MATLAB/Octave or Python. And yeah, the data is free. The toolboxes are open source. You can do with it whatever you want. You can modify it. You can tweak the toolboxes. You can look at how they work. And of course, you can also look at the data that we have. We have at the moment some agricultural commodities. We have 44 futures. All of them have US underlyings with the exception of the Dow Jones Euro Stoxx 50. This is an index in Europe, but the future is also traded on the CME. So these are 44 very liquid futures that are traded on the CME. Some of them are agriculturalists, and we've got government bonds, 5-year note, treasury, 5-year treasury note, 2-year, 10-year, and so on. Then a couple of Foreign exchange futures, Australian dollar, British pound, even the Mexican peso. Then energy futures, this would be crude oil, heating oil, natural gas. Then indices, they are very liquid and increasingly popular in the last years, E-mini, S&P 500. And then, of course, metals, industrial and precious metals, so gold, copper, platinum, silver, and flex. So this is a list with an overview. The ticker is, in our case, always an F underscore and then the market symbol. F denotes the future on our platform. Everything else would be a stock. We also have the stocks of the S&P 500. They don't have an F underscore, but just a normal ticker that you also can find on Yahoo Finance. Okay, then let's maybe discuss the toolbox before we start with developing a trading strategy, a quantitative trading strategy on futures. The toolbox is a framework that empowers you to develop a quantitative trading strategy and to run a backtest. I said already we have it in MATLAB/Octave and in Python. They have the same functionality. Maybe on a side note, at the moment we have the toolbox in Python version 2.7, since it's more popular still, as far as we know. However, if the majority of our users want us to switch to 3-point-something, then we will of course do that too. Our goal is to support the full arsenal of both languages, so you can use every library, everything that there is for Python or for MATLAB, from machine learning to genetic algorithms, everything. And it's also free and open source. So you can always take a look at the toolbox. You can take a look at how the backtest runs, how the data is handled, and so on. So it's really there for you. You can tweak it. You can adapt it to your needs. If you are missing a feature, shoot us an email. We will work hard to include it. Okay. A trading system. This is what we're going to build in a couple of minutes. Is for us always a Python or MATLAB function with a specified template, so with a well-defined function template, where you can define the variables that you want to use for your computations. In our case, this is just the market data at the moment. We're currently testing the commitment of traders data for futures in beta, so this will be released in a week or so, hopefully. But for now, it's the primary market variables like date, open, high, low, close, volume, and for futures, open interest. And we work at the moment with daily data resolution, daily market data on futures. Our data goes back until 1990, so you have 25 years of market data to run your backtest on. You can select the arguments that you want to use, so simply by leaving them away here in the declaration, in the function header, leaving them away. If you don't need the high and the low, then just leave it away and you don't get the data for it. You don't need it for your computations. Date is always a vector of the dates in the format 4 digits for the year, 2 digits for the month, and 2 digits for the day. It's an integer. And then, of course, for the markets that you want to trade or test, you get open, high, low, close, or whatever you have specified in the function template. These are matrices with a column per market and a row per day in every call of the trading system function. And the function is looped through the time, so called for every day in the backtesting period. And you're asked to compute as output, as return value of the function, a vector P that has an entry for every market in your portfolio. And this vector P, we will get to that right here. Yeah. This vector P is, if it's positive, it's a long position. If it's negative, it's a short position. If it's 0, you don't trade the market at the moment at all. P is a percent allocation of the available capital at time t to that particular market. So the sum of P is always normalized to 1 in the backtest. It's good practice if you do it yourself, because then you know exactly how much of your resources, of your available resources at each stage you allocate to one of the markets. Yeah, a positive P is a long position, negative P is a short position. And the last thing that we need to discuss here in the function template is the settings struct. With the settings struct, you can define the environmental variables of your trading strategies. So the settings of your trading system in this case. What would these settings look like? What can you define? You can define the portfolio that you want to trade. So maybe you don't want to develop an algorithm for all the 44 futures, but just for foreign exchange futures, you can define them in settings. So then the second thing is, how much data do you need for your trading system? Usually a trading system depends only on a rolling window of market data. So for your decision, if you want to buy gold tomorrow, the price of gold in 1990 is probably irrelevant. So usually at some point the historical data becomes irrelevant for your today's trading decision. This is the so-called look-back window. So your strategy depends on a rolling window of data. Then this is something that I can only recommend is good practice to leave some of the market data for an out-of-sample test in the end. So this is good practice of developing quantitative trading strategies. It's also done in machine learning. You train your model or you develop your model only on a portion of the data and then test it on data that your model has never seen, how you developed it. This is the closest you can get to a simulation of your system on live market data. This is good practice. You can do that in the settings struct if you want. Of course, you can use all the market data until today. We have it on our platform. You can feel free to do with it whatever you want. But a good check for robustness of your strategy is if you save some of the data. Usually, I would recommend the last 2 or 3 years or something like that. Until after you're finished developing your algorithm, and then you run a test. This is the so-called out-of-sample test on market data that you haven't touched when you develop an algorithm. Yeah, and then of course the transaction cost assumption, summarized slippage and commission. Transaction costs, I will just briefly touch that concept. When you buy something on a stock exchange or on a futures exchange, you usually don't get it to the price that you want to get it or at the last price quotation. Usually you either have to cross the order book or pay a premium. If your order is too large, then you would eat your way up through the order book, so to say, if your order is larger than the best bid or the best ask. You have to pay the broker. You have a market impact with your order. All of that is summarized in what we call slippage, and we model the slippage as simply 5% of the daily range. The daily range is defined as high minus low. So the more volatile a market is on a day, the higher is your expected slippage on that day. This is a very, very simple and basic model to estimate slippage and commission. We somewhat overestimate slippage and commission with that, but it's better to overestimate it in the backtest rather than underestimating it. Everything clear to slippage? Yeah?
The backtest, which price is a trade price? Is it close?
Yeah, that's a very good question. So the question was, which price is the trade price? We provide you in every call of the trading system function with the true dollar price of the full contract. So the last price is always the correct price. So let's do an example again. Let's assume we would trade the 10-year note, and the 10-year note, a full 10-year note notional contract size would be 130K today. Then your last entry of the close vector that you'll get, or of the close matrix, depending on if you have more markets than that, would be 130K. So this is exactly what we give you in every call of the iteration. So the last price that we give you is always the correct price. Historically, this is not necessarily true because we have to roll the contract eventually. And when we do a roll, the contracts don't cost the same. So it could be that we have to pay a premium, add a contango, or backwardation. So we have to filter out that gap that we have, that you have a steady course, so to say. Does that answer?
That's for evaluation. Let's say I have my system generates signal at the end of the day today.
Mm-hmm.
So what will be the trade price? Is it next
Okay.
or next day open, next specified
Okay, so the question is, if you generate a signal today, to what price or at what price the order will be filled? At the moment, we generate the orders overnight, so your order will be filled market on open. If we don't create a market impact with that, so if we trade your system with significant size, so if an institutional investor wants to trade, I don't know, 10 million or 100 million with your system, then you probably won't trade it with market on open anymore, but with something more sophisticated. This could be a volume-weighted moving VWAP, yeah, or other very sophisticated order execution algorithms. But the point is, you don't need to worry about that as Quant. This is done on our end or on the institutional investors' end.
But the backtesting, that's the open.
Yeah, backtesting is always open, market on open. Mm-hmm. Okay, this is an example of the settings. We probably want to see the Python code, right? This would be here. Yeah, this is a settings dict. You can define several properties of the settings. The first and very important settings are here. The markets that you want to trade. In this case, we would trade cash, the S&P 500 future, silver, and the Dow Jones future, but in both cases the minis. The cash market is simply an auxiliary market that has a constant value over time, so this can just be used to allocate a portion of your available capital at stage T to not being invested, so to say. So let's do an example, if it's 2007 or 2008 and everything goes south, then I might want to decide with my algorithm I don't want to be invested with 100% of my available capital at that stage in the market, so I could allocate a portion, let's say 0.5, so half of my assets to cash in this case. Yeah, the other markets are just the normal markets, the normal futures that you get. You can define a slippage. I strongly suggest and recommend not to change that number too much, because on our end we evaluate all the strategies that we get before we market it to investors. We evaluate all of the strategies with exactly these slippage settings. So even if you change them locally on your computer, once you upload them to our platform to market it to institutional investors, we test them with 0.05. But it's an interesting variable where you can assess how much your strategy depends on slippage. You can play around with the number. You will see for strategies that trade very often, very frequently, this number generates a huge impact, of course a negative impact. Slippage always works against you, never for you. And on systems that adapt or adjust their positions very slowly, the slippage setting is almost irrelevant. Yeah, then the budget, the initial budget, this is just a pretty number that you can fill in there to run the backtest and to get a feeling of how much fees you would have collected with your strategy over the years if an investor would have invested initially $1 million in your strategy. And then sample begin and sample end. This is the out-of-sample test. So if you want to ignore part of the data for an auto-sample test that you want to run in the end when you're done developing your strategy, when you're finished with it, then you would define sample end prior to that time. So in our case, maybe the end of 2013 or so. Yeah, and settings lookback is just the number of days that you get, or the number of information, the size of the information that you get in each call of your trading system function. In our case, in this example, it's 504 days. This is roughly 2 years of market data. One trading year has 252 days. So the computations that I make in my system only depend on the values of the markets in the last 2 years. Yeah, we already touched the mechanics. So your trading system is called every day. You are asked to compute a position size vector P that is either positive or negative or 0. If it's positive, you want to trade the market long. If it's negative, you want to trade it short. If it's 0, you don't want to trade the market at all. The sum of P's is normalized to 1, so this is really a percent allocation of your capital at every stage across the markets in your portfolio. Any questions to that? No? Okay, cool. how to run a backtest. If you have installed Python 2.7 already on your computer, I will walk you through that in a minute. You just need to import the Quantiacs toolbox. This is the toolbox that our open source toolbox that has all the backtesting routines written in it, and call the function runts, the method runts here, run trading system, and this runs the backtest of the file sumts.py that contains the logic of the trading strategy. And in MATLAB it's pretty much the same. You just type runts and the name of the file where your trading system is stored, or the path to the file, and you get the backtest in MATLAB. So it's pretty much the same in both languages.
You do the run TS. Everything is run locally, right?
Yes, exactly. Our toolbox is designed in a way that everything you do is local, so you download the data to your computer, the toolbox is run locally on your computer. You can look through all the code, so there are no hidden backdoors that communicate with our servers or so. So it's really, it's open source. Do with it whatever you want. If you want to market it to institutional investors, feel free to use our platform. Then you can just submit it to our platform. From that day on, we start generating a simulation of your trading strategy on live market data. So a trusted, a proven backtest or a proven simulation, build up a track record of your strategy. And with this track record, we market it to institutional investors. So usually an institutional investor is not interested primarily in a pretty looking backtest, because that's, we all know it's easy to fabricate a backtest that tells you the past exactly. What they're looking for is our systems where you cannot tell where the backtest ends and where the live simulation starts. So systems that work equally well on live market data as they did in their backtest. This is, of course, what institutional investors want to see. And this is also why it usually takes 3 to 6 months at least of live simulation of your system on our platform before institutional investors consider an investment in your strategy. So this has some warm-up phase. This is in the nature of things. Okay, then we can pretty much switch to live developing trading strategy. Let's maybe have a 3-minute break. If you're thirsty, there is water outside. If you have questions, shoot, and we will start in 2 to 3 minutes with the live development of a trading strategy.